Thank you for joining me today. I'm Rural Media Group Chicago News Bureau Chief, and I'm pleased to bring you 2014 in review covering geopolitics, economies, and the U.S. farmer. My guests today are James Koutoulas, CEO of Typhon, which runs several specialized commodity trading strategies and a commodity pool platform; Robert Chesler, Vice President of the Foods Division at FCStone, a Fortune 500 financial services firm specializing in commodity and advisory execution; and Bob Iaccino, Chief Market Strategist at Tethys Partners, which provides comprehensive physical, financial, and logistical solutions across the global energy complex. Thank you all for joining me today.
Thanks for having us.
So let's get right into it. 2014, so many global events that affected the markets here. Which stood out specifically to you individually and the products that you trade? James, let's start with you.
I mean, it was just an absolutely wild year in commodities. I mean, it started off with the polar vortex, one of the coldest winters ever on record, especially in the Midwest. Had vol you hadn't seen in natural gas in 30 years. Over the summer, you had record harvests in corn. Grain prices just plunged, and then in OC, you saw this absolutely crazy rally there as we saw 9 standard deviation moves in the soy meal complex. Also in October, you saw volatility come back to the stock market, albeit briefly, when Ebola reminded people, well, stocks actually can go down, and then vol just got crushed right back down lower again. So been a lot of trading opportunities, a lot of very interesting stories.
Absolutely. Robert?
You know, what catches my attention really is the opportunity that's been presented by all the volatility that we've seen. Amidst all the whiplash of the market, be it up or down, both producers and end users, retailers alike, have all had great opportunities to really lock in margins. And what has that really all been centered around? It's really been centered around basic human nature. You know, people like to talk about humans evolving, becoming more sophisticated, but you look around at what's happened with our friends in Russia and North Korea and all over the Mideast, and it's almost the same basic caveman mentality of I see, I like, I want, I take. And that's really what, alongside some of the weather issues in Mother Nature, has really catapulted this market from a vol standpoint, and most importantly from an opportunity standpoint.
Yeah, great. And Bob?
Well, I think James and Robert made some great references to some of the things that happened, but the thing that Tethys Partners is an energy company, and obviously in toward the end of the year, starting in about July, we saw one of the great collapses in energy. And when you go back to the harsh winter that we had with the rise in heating oil and actually the movement of heating oil in the wrong direction. Generally in winter, heating oil travels from the U.S. to Europe. This year, especially toward January and February, it was traveling from Europe to the U.S. and the prices spiked. And then we saw this massive collapse in oil from 107, 105 in July, down to very recently being in the 50 handle, which we haven't seen since 2009. And that's been something very difficult for the majors as well as the trading firms to handle. And it's just been very, very active, very volatile, as Robert mentioned, and just exciting overall.
And in terms of the Fed, Bob, with the arguments going on within the FOMC, the discussions about when to raise rates, do you believe that they're all going to fall in line with Fed Chair Yellen, as they did with former Chairman Bernanke?
I do. The chairman puts his or her stamp on the Fed throughout their tenure. They really, we referred to the Greenspan Fed, we referred to the Bernanke Fed, we're now referring to the Yellen Fed. And the thing that people need to understand about Janet Yellen is that her and her husband both are a champion of sort of higher wages as opposed to lower inflation. So they would allow more inflation theoretically than any Fed chairman we had before in order to bump up wages. They both have a theory. I hate to keep referring to both of them, but you know, dinner time conversations bleed into policy when you have that kind of a role. And they're a fan of wages increasing, happier workers, more productivity, better purchasing power. That is their theory. They've written papers on it, and they're going to fall in line behind Janet Yellen, just like they did Bernanke. So people who are now predicting that 2015 they're going to raise rates sooner are probably going to end up being wrong.
And in terms of third quarter, we saw the U.S. dollar index see its largest quarterly gain in 6 years, while the Bloomberg Commodity Index saw its largest quarterly decline in 6 years. Grains, multi-year lows at this time. Energies falling as well. But Robert, livestock, cattle, hog prices, dairy, all at record highs. What happened here?
The more we trade and the more money becomes prevalent in the marketplace, the more we have what I like to call connectivity. We have correlation of markets and money moves things. But at the end of the day, from a fundamental standpoint, in some of the markets you noted, particularly livestock, you have some fundamental lags before you can impact the balance of supply and demand. And so what we've done in the U.S. dollar has really created a landscape where it's going to be very challenging to export, and that's certainly going to impact the S&D tables, but there's a lag impact for that to happen. The price itself will certainly attract more supply and more desire to raise more cattle, for example, but again, there's a lag in the gestation period to be able to produce those cattle. And so we're seeing that play out here, and again, within that is opportunity.
And James, I want to touch on grains here. China has been such a major player throughout 2014. How has their economic health, their growth in manufacturing sector, their rejection of U.S. commodity imports really been affecting markets this year?
Believe it or not, despite the fact that China is by far the leader in driving demand for soy and really pork products worldwide as well, a lot of that's pretty inelastic. The Chinese, they need their soy, they're going to buy it, really regardless of what's going on, and imports have been pretty steady this year.
And now, speaking of China, overtook the U.S. for the first time since Ulysses S. Grant's presidency for the #1 global economic powerhouse. Now, this is measured by IMF data released December 4th. I have to ask here, is this the most reliable measurement here? Is the U.S. officially #2? And some people are even arguing that there's a disconnect between China's economic data and their stock market. And feel free to all chime in on this, but Bob, I'll begin with you.
Well, I'm going to do a little bit of the patriotic thing first. We're still in charge. I mean, we're still the biggest, most important economy. China started calculating their GDP based on IMF rules, which is what the rest of the globe does, and there's a population equation in there. Now, GDP is basically goods produced and bought within the border, and when you have a population like China does, growing, I mean, India is probably going to surpass us in 25 years. We're not going to be the #1 in terms of the size of our GDP. Having said that, commodities priced in dollars, especially energy. Energy, to me, obviously I'm a little bit biased, the most important thing that's traded globally is energy. It's the most costly thing. It's one of the most volatile. It's priced in dollars. The U.S. is still the largest consuming economy. We remain the most important economy. We can't drag the rest of the world up, but we can drag it down.
I think there's a couple ways to take a look at it. It's hard to argue with a lot of what you said, but let me give a bit of a counterpoint. There's a short-term perspective and a long-term perspective. From a long-term perspective, I think a lot of what's going on here is we're trying to level the playing field out. We're trying to realize that this is a global economy. We're more interconnected and we're more interdependent on each other. So does one nation call the shots or another? I think the reality is it's becoming more and more of a symbiotic dependency relationship from all of these major global players. So it's a great headline, it's great fanfare, and it attracts a lot of that attention and banter. I think it's much to do about nothing, though, from that IMF headline, to be honest.
And I got to agree with both of them and take it just one step further. PPP, in terms of ranking people first, second, whatever, don't think it's the best statistic there. I mean, China is a manufacturing, export-driven economy. U.S. is a consumer. And you talk about global economies and how intertwined we are. The U.S. needs China manufacturing all our iPhones. Okay, everyone's buying an iPhone. Someone's got to make it. We're not making it in the U.S. So the U.S. Is going to continue to be the driver of demand, I think, for a long time. I mean, especially now you see the dollar strengthening. So I care a little bit less about the PPP number and just more about how China needs the U.S. just like we need China.
Yeah, so they should adopt the Chicago motto of second to none, correct? Yes?
Absolutely. Yes. And one more thing, QE, you mentioned the disconnect between the underlying Chinese economy and the stock market there, and China, I think, is kind of falling victim to what a lot of markets have seen over the last 4 years. As central banks put more and more liquidity in the system, asset prices rise.
Yeah, and in terms of geopolitical events, a lot of things really affecting the markets here. I mean, with Russia invading Crimea, the unrest in Ukraine, when Israel invaded Gaza, and everything going on in Syria and Iraq. I mean, we saw clear effects across all financial markets. VIX index, of course, jumped during each of those events. I want to ask, what each of you do in one of those situations that you can't predict. For instance, the down Malaysian plane, once those markets started moving initially, once everything saw these huge percentage year climbs, either up or down, what was your initial reaction? Do you let your buy sell stops be hit, or do you actively begin to move things around? James, what did you do?
Well, when it comes to our VIX trading, we take a fully systematic approach, and basically all but 2 of these spikes we faded. So we got long vol in end of January, early February. Turned out to be a pretty good trade. Then we went and got short again. Same thing in October. In October, as equity markets really kind of went nuts with Ebola and some of the Russia, Ukraine issues, we got long, we got short again, we got long again, we got short again. But generally, people tend to overreact in these event situations. And when you see these big spot VIX moves, it's usually a smart move to fade those.
And true, I believe you'd also have to look at which day of the week those events occur on too, because it's not like people would want to go into the weekend with such uncertainty. Is that correct?
I mean, I think during the Ebola scare, that was people definitely wanted to be long vol.
It's definitely correct with oil right now. We've seen collapses over the last few weeks. Basically going Wednesdays and Thursdays, and Friday there was some covering and some quiet. The volume dies down. If there's going to be an OPEC move anytime in 2015 in terms of cutting price, it's going to happen on a Sunday when traders aren't in. So that's definitely been the case. You saw that in the S&P during the Ebola scare that James mentioned. To me, one of the silliest spikes in vol ever was the Ebola scare, but you can't see that until it's sort of a rear view mirror comment. But definitely those factors as to when it happens and how deep the scare is. VIX's nickname is the fear index. It's pretty appropriate.
I think it's a great question. It makes me think back to something an old friend of me said a long time ago. He posed the question to me. He said, why do you think the average speculator, a lawyer in downtown Chicago, might get in speculatively to commodities markets? And me being a bit of a smart aleck, I said to make money. And his response was, well, sure, but he could invest in lots of things, stock market, real estate, make money. Why commodities? I scratched my head and I was dumbfounded and said, why? His perspective was the reason they choose that is so that they can feel connected to the world, that they can wake up in the morning, they can hear about one of these major global events that happen thousands and thousands of miles away and still feel the impact. And in the background, they can have figured out the pieces to the puzzle in advance and profited off it from being smart enough to do that. The reality is, as we become more and more interconnected, it's harder to figure out what's going on farther around the world than it is in our own backyard. And I think that that's really contributing to the volatility that we're seeing. And so your question comes down to a twofold answer from my perspective, one from the speculative camp and one from the hedge camp. From the speculative camp, I think both gentlemen here have addressed it magnificently. From the hedge camp, I'm going to say it's a little bit different. We want to filter out what happens on a one-day move. To us, that's really just noise. As James said, an overreaction of the market, and it's really pivotal for our customer base from a hedge perspective to focus on monthly, quarterly, yearly. And so the positions they have in place are usually done from a very long-term strategic business plan because they have to be in the market physically no matter what. So what happens to that price is going to impact their bottom line or their quarterly reports regardless, because they have to buy that wheat, they have to buy that cheese, they have to buy that hog. But what they need to have is some sort of ability to smooth out these types of events. So they're going to stick with their game plan.
And in terms of these long-term strategies with the volatility, with speculation even, I was recently at a UN conference where they had focused on rural women's role in agriculture, and basically the declaration had said that speculation of food, of the markets, is not really a good thing because of the volatility, the increases in prices. I mean, is speculation in commodities a bad thing, or is there a disconnect between food security, nutrition, and too much blame put on speculation?
Well, Allie, you kind of remind me of Obama right now, calling out the evil speculators. Like, where was the UN this summer as we saw grain prices plummeted and we had super low commodity prices because of that? Look at what oil's doing now. We're evil speculators. Thanks for the cheap oil. But the reality is, going back to what Robert just said about hedge markets, that's why we have speculators. Without hedgers, if hedgers didn't have speculators to lay off their risk, to lay off their hedge premium, all commodity prices would be more expensive because the users and producers of these commodities would have to charge and pay higher risk premiums because you can't hedge out the risk. So just like equity markets exist so that companies can go out and get capital to grow their businesses, all the futures markets exist primarily to serve hedgers. And without hedgers, you really don't have futures markets. And they're incredibly important to maintaining price stability.
And any comments on speculation, guys?
I have to agree with James. I think that I'm sort of neutral on the speculator conversation, really, because of something that James mentioned sort of with a great piece of sarcasm. I think that when oil prices are rising, they're screaming about speculators. When they're falling, no one is screaming about speculation. And the most aggressive study I've ever seen said that 12% of oil price moves, and I'm speaking, of course, about my main market, but 12% of oil price moves can be attributed to speculators. So when it was $117, it was about $10 too high. Now that it's somewhere in that 50 to 70 range that it's been floating, it's about $7 too low.
And Bob, I'm glad to have you here because I know on my radio show Commodity Wrap on SiriusXM, we had been discussing that a few months ago you were calling for $75 oil. Now, 10 days later, Goldman Sachs decided to say 10 days later, as I said, $75 oil as well. We hit that, we saw that. Now broke beneath $60 a barrel in December. What happened here? What led to this? And I want to ask you where we're going next.
Well, I didn't know when Goldman called me that they were going to repeat it. But essentially what you have is there's two myths going on, in my opinion, in the oil markets. Number one, that Saudi Arabia is targeting the North American shale producers. They're not. All right, we are the only major oil producer. Now, we flip-flop between first, second, and third, between Saudi Arabia, Russia, and us. We're the only one that's not a government-owned oil complex. We're the only one that doesn't fund our expenditures structurally through our oil complex. We do it through tax revenues. So there's no way to actually directly target the North American oil complex except to let prices free flow, in which case the inefficient producers are going to die or be bought out. The efficient producers will stay. And that's what Saudi Arabia was saying when they were saying that oil prices will stabilize on their own. That was a reference to North America. The targets they have are for the mischievous, the misbehaving members of OPEC, and some of the fringe nations that want Saudi Arabia to raise the price, but yet they continue to produce, they don't cut production. So your Venezuelas, your Mexicos, your Russias, that's who they're targeting. Given all of that, the wells that have been drilled will continue to produce. I just saw a report that basically said the average well is losing about 200 barrels a year, and the new wells are expected to produce about 8,000 more. Okay, so it's going to be 18 to 24 months before U.S. supply starts to taper off at lower prices.
And speaking of 18 to 24 months, I want to get into then more of an outlook. First, recap what we saw in those grain markets. I mean, to see corn hit a 5-year low in September, right at the end of September. Actually, I believe it was October 1st. And then see this huge rally in grains throughout October. I mean, what caused this action here? And also looking at energy, looking at natural gas, and Bob, you had discussed oil as well, heating oil. How are all of these factors going to contribute moving into 2015?
Corn and meal were two different stories here. Corn, everyone was thinking biggest corn harvest ever. I think the market got a little bit over optimistic and yields fell short and went from there. In terms of the soy trade, which was, I mean, just record-setting, like mind-blowing trade that most ag CTAs got wrong, just really across the board. Getting political again. Infrastructure, aging infrastructure in the U.S. combined with the shale boom meant that soy crushers couldn't get the beans to crush. Rail lines got backed up. There were huge logistical problems in getting the beans delivered. And you also saw some demand coming from the hedge fund side of the business, where a lot of those guys were short in September, and you saw some big-time short covering drive it up.
And Robert, do you agree with what he said with what's caused the moves in the grain markets here?
Yeah, I agree completely with a lot of that. You know, what I'd like to kind of tie it back to is the question just a few moments ago about speculation. there's certainly a speculative factor to that. And that speculative debate goes on as to what is the impact of the funds and the money in the market, as James was just even noting in the explanation of what's happened to the grain prices here of late. But when you look at that speculative factor, you really try to address how much of an impact. You could debate it all day without a definitive answer. I think I've got a unique perspective speaking from the dairy markets, because we're one of the few markets that's actively seeking increased speculation so that we can resolve the exact issue James was touching on earlier, which is more speculative participation so that there's more liquidity, so that there's more ability to lay off the hedge risk.
Take that, Obama!
And very quick, I'm sorry, go ahead.
Oh, and when you get that, you wind up with a smoother market and hopefully decrease in volatility. And what we see in the grain markets, to address your question about the grain prices here as of late, is that fund money allows the farmer to get in and out. And so you've seen the farmer have a need to come in and a need to come out, and right now he's holding the grain he has.
And Bob, very quickly, what kind of prices are U.S. consumers, U.S. farmers looking at in terms of heating oil, petroleum, what people are going to be paying at the pump moving forward?
I think you're going to have a nice little 6 to 12 month area of lower prices for both.
Thank you very much, gentlemen, for joining me for 2014 in Review. That's all we have for today, and I'm very pleased that you all joined us here to see the geopolitical, economic, and how these factors affected the U.S. farmer. Back to you.